Welcome back to the Daily Crypto Deep Dive, the show where we cut through the noise and tell you what's really happening behind the headlines. If you're listening right now, take a quick second to follow the show and drop a 5-star rating. It helps the algorithm more than you think and keeps independent crypto coverage alive. So, let's talk about what might be the most important development since Bitcoin's ETFs went live, Ethereum's own ETFs, and what they really reveal about how Wall Street plans to reshape crypto's future. When Bitcoin ETFs finally launched in January 2024, the entire landscape changed overnight. Trillions of dollars in institutional capital suddenly had a regulated, compliant way to touch digital assets. Within 6 months, Bitcoin ETFs had already pulled in over $22 billion in assets, one of the fastest-growing fund categories in history. That set the tone. It proved the demand wasn't theoretical. It was real, deep, and waiting for permission to move. So it was only a matter of time before the same question landed on everyone's desk. What about Ethereum? That answer came on July 23, 2024, when the U.S. Securities and Exchange Commission finally gave the green light for multiple spot Ethereum ETFs to begin trading. That single approval flipped the switch. Overnight, Ethereum moved from being a smart contract platform for developers into a fully fledged institutional asset class. BlackRock's iShares Ethereum Trust, ticker ETHA, and Fidelity's Fidelity Ethereum Fund, ticker FETH, were among the first to hit the market. Alongside them came similar products from VanEck, Ark 21 shares, Bitwise, and a handful of smaller issuers. Within days, trading volume exploded. Institutions that had hesitated for years now had a clean, regulated doorway into the world's second-largest blockchain. Now here's what matters. These ETFs aren't futures products. They're not synthetic. They are spot vehicles that actually hold Ethereum in custody, structured as grantor trusts, designed to track the market price as closely as possible. When you buy shares, you're getting direct exposure to Ethereum's price, just without touching a wallet or managing keys. But there's a catch, and it's an important one. The SEC's approval came with a very specific condition. None of these ETFs are allowed to stake the Ethereum they hold. That means they don't earn network yield, they don't participate in validator consensus, and they don't collect staking rewards. Every single issuer had to strip staking language from their filings to satisfy regulators. That's the trade-off that got these funds across the line. It's clean, it's compliant, but it also means the ETFs won't capture one of Ethereum's biggest built-in advantages, yield. So why would institutions still rush in without that extra return? Because for them, it's not about yield. It's about access and legitimacy. These ETFs provide a way for fund managers, pensions, and corporate treasuries to hold Ethereum exposure inside the same portfolios that already hold equities, bonds, and commodities. They can tick the compliance boxes, clear audits, and trade through their existing custodians, all without touching an exchange or worrying about private keys. In other words, it's not about crypto convenience, it's about portfolio integration. BlackRock's CEO, Larry Fink, has been hinting at this strategy for years. He's called tokenization the next generation of markets, and he wasn't exaggerating. For BlackRock, the Ethereum ETF isn't just a standalone product, it's a testbed for a far larger play. The firm's long-term goal is to bring traditional assets, bonds, real estate, even money market funds, onto public blockchains using the same infrastructure that powers Ethereum. The ETF is just the first, cautious bridge between Wall Street and on-chain finance. That's why the approval mattered beyond the headlines. It signaled that regulators were finally comfortable enough with Ethereum's structure, including its proof-of-stake consensus model, to treat it like a commodity rather than a security. Gary Gensler never said it explicitly, but the SEC's decision to approve spot ETFs on Ethereum effectively settled the debate in practice. You can't approve a spot ETF on an asset you consider an unregistered security. That subtle shift changed everything. It gave institutions clarity and gave Ethereum something Bitcoin already had: official validation. Now, the first few months after launch weren't explosive in terms of inflows. They started cautiously, just like the Bitcoin ETFs did. By late summer, assets under management across all the Ethereum ETFs hovered around $5 to $6 billion. But analysts were quick to point out that this phase was all about infrastructure, not momentum. Once broker-dealers integrated the products into model portfolios and retirement plans, the flows would start scaling. And here's where it gets interesting. Even without staking, the ETFs created indirect pressure on Ethereum's supply. Every unit custodied by BlackRock or Fidelity is effectively removed from circulation. These funds can't lend it, can't use it as collateral, and can't stake it. They hold it cold. As more capital flows into ETFs, that locked-up supply acts like a slow-burning supply shock. It's quiet, but powerful. Institutional strategists are already modeling that impact. JPMorgan's Nikolaos Panagiotsoglu, who's been one of the most consistent voices analyzing Ethereum fundamentals, noted in a July report that every $1 billion of ETF inflow could absorb roughly 200,000 ETH from liquid markets. Over time, that tightens the float and could make price reactions more violent to the upside. Meanwhile, Bloomberg's senior analyst Eric Balchunas has said that Ethereum's ETF adoption curve will likely mirror gold's in the early 2000s. Slow to start, then exponential once institutions integrate it as a standard diversifier. The bigger narrative, though, and the one BlackRock's clearly playing for, is tokenization. In March 2025, BlackRock quietly expanded its partnership with Securitize to tokenize portions of its short-term treasury fund on Ethereum. That pilot program allowed accredited investors to buy blockchain-based shares, representing slices of the fund's holdings. That might sound small, but it's enormous symbolically. It shows that the world's largest asset manager isn't just offering exposure to Ethereum, it's using Ethereum's infrastructure for its own financial products. When Larry Fink says, "We're just getting started," this is what he means. The Ethereum ETFs are the public-facing product, but the real endgame is an ecosystem where trillions in traditional assets move seamlessly across tokenized rails. Ethereum becomes not just a cryptocurrency network, but a settlement layer for the global financial system. Of course, there are risks. The concentration of custodianship is one of them. Coinbase Custody currently serves as the primary custodian for multiple Ethereum ETFs, including BlackRock's and Ark 21 shares. That's efficient, but it also introduces single-point risk. If too much validator power or asset control centralizes under one provider, it could tilt Ethereum's decentralization balance. Then there's the regulatory overhang. Even though the SEC approved the ETFs, it hasn't fully clarified the long-term stance on staking and yield products. The Commission could still revisit those boundaries, especially if other jurisdictions start allowing staking ETFs. The European Union and Hong Kong are already exploring exactly that. But perhaps the most fascinating shift isn't technical. It's psychological. For years, Ethereum was the chain of the builders, the developers. Now, it's also the chain of the institutions. That dual identity will define the next few years. On one side, you'll have retail and DeFi innovation continuing to push boundaries. On the other, you'll have BlackRock, Fidelity, and the entire ETF ecosystem embedding Ethereum into the mainstream. And that raises an uncomfortable question. Can a blockchain remain decentralized once Wall Street starts using it as infrastructure? Vitalik Buterin has warned about this exact tension. In an interview earlier this year, he said Ethereum's resilience depends on diversity, of validators, of clients, and of participants. He acknowledged that institutional participation is inevitable but stressed the need for protocol-level neutrality. In other words, Ethereum can't care who uses it, as long as the rules stay the same for everyone. That principle will be tested as ETFs grow. If large custodians start running validators, or if regulatory pressure changes staking behavior, Ethereum's consensus dynamics could shift. But so far, the network has handled these transitions with remarkable grace. Decentralization has weakened in some areas, strengthened in others, but the system keeps evolving. From a market perspective, the impact is already visible. After the initial volatility, Ethereum stabilized around the $4,000 range. Analysts from Ark Invest projected a possible climb to 7,000 by mid-2026 if ETF inflows maintain current velocity. Raoul Pal remains one of the more aggressive voices, forecasting 10,000 plus in a full-cycle expansion, assuming global liquidity normalizes. That may sound ambitious, but the fundamentals are lining up. Network activity is strong. Layer 2 usage keeps climbing. Stablecoin transaction volumes on Ethereum hit record highs in Q3 2025. Even with competition from Solana and Base, Ethereum remains the hub where everything important eventually connects. And here's the irony. The same decentralization that once made Ethereum seem ungovernable is now what makes it safe enough for Wall Street to use. No single entity controls it. No one can rug the network. For institutions, that's not chaos, that's comfort. This convergence, where decentralization meets regulation, is the real story. The ETFs are the symbol of that shift. They make Ethereum palatable without diluting its purpose. They don't require you to understand gas fees or wallets or bridges. They wrap it in a ticker, a fund, and a prospectus. It's clean. It's simple. And it's exactly how adoption sneaks into the mainstream. If you're holding Ethereum yourself, this moment matters more than any single price candle. Because from here on, every pension fund, every corporate treasury, and every wealth manager can now allocate to Ethereum the same way they allocate to gold or tech stocks. That changes demand permanently. Now a quick reminder. If you're holding real crypto, not ETF shares, keep it safe. With more institutional attention comes more scams, more phishing attempts, and more fake custodians pretending to be legitimate. Protect your assets with a hardware wallet. Ledger wallets are the industry standard, and if you need one, check the link in the show description. So, here's the takeaway. The Ethereum ETFs aren't just new products. They're proof that crypto's long-term thesis is winning. The same system Wall Street once ignored is now becoming the foundation for its next evolution. Whether that makes Ethereum stronger or just more conventional depends on how it handles the power it's about to receive. But one thing's for sure. This is no longer a niche experiment. It's the mainstreaming of programmable money. Follow the show, drop that 5-star rating, and share this episode with someone who wants the signal without the noise. Because understanding Ethereum's ETF era isn't just about watching price charts. It's about seeing how the future of finance is quietly being built, one approval at a time. And as always, we'll see you at the top.